Hi. While Fed Chairman Jeremy Powell's latest speech in the annual Symposium of Central Bankers at Jackson Hole was consistent with other senior Fed officials in recent weeks, the comments pushed back against the market view that policy rates are to peak in the next 6 months and will start to come down in 2023. In particular, this suggests the Fed still sees inflation in the US as an issue and is willing to keep rates high and tolerate weaker growth so as to tame price increases, pointing to no rate cuts next year. The market is now expecting policy rates to peak at 3.75 to 4% in early 2023. We think we could get there before 2022 year-end with 75 basis point hike in September, 50 basis points hike in November, and 25 basis points hike in December. Since we have the August job numbers this week and another round of consumer price index data before the September Fed meeting, the outcome can still change. Weak job and/or weak inflation data could still persuade the Fed to offer 50 basis point hike on September 21st. Yet, hawks would argue that a 75 basis point hike would reinforce the Fed's determination to control inflation after failing to address it early in the cycle. The current inflation and growth trajectories imply 2023 could see a small quantum of hikes, while provide limited rationale for cuts. Hence, investors should focus on the September summary of economic projections, as this will show whether Fed officials are keeping to their June forecasts on policy rates or revising them higher again. The unemployment rate forecast also deserves some attention, since this reflects the amount of economic pain the Fed is willing to tolerate. Our view of staying more focused on portfolio resilience with a preference for fixed income remains unchanged. High-grade corporate credits should provide more consistent performance as we ride out the Fed's hawkish stance. On equities, there will likely be more earnings downgrades in the coming months. The focus on quality companies who can then deliver more consistent earnings performance over weaker growth would be preferred.